Welcome to Escape the Clock. Today's episode is a little different than our usual format. Normally, we're focusing on specific tactics for escaping the clock, but today we're taking a look at the operating system itself. Today, I'm joined by Paul Musson, and he wrote a fascinating book called Capital Offence. And look, I've read a lot of books for the podcast at this point, but I have to say, I really learned a lot from the book and from my conversation with Paul. Because of that, it went a bit longer than usual because we had to unpack some of the most fundamental misunderstandings in finance. He is an expert in this, and he really put himself out there to explore a lot of these critical differences, like between money and capital, and how the central banks work, and how we live in a leverage-based system of debt, and how it really hurts our ability to save and invest effectively. These are very important things to understand when it comes to achieving financial freedom, how to protect yourself from the massive wealth transfer that's happening right now. It can be a dense conversation, but it challenges a lot of the conventional wisdoms, and I promise you it is worth every minute. So here is my conversation with Paul Musson. Welcome back to Escape the Clock, the show where we highlight strategies and approaches for achieving financial freedom and having the option not to work. I'm your host, Daniel C. Rogers. If you're listening to this podcast, you're likely doing everything right. You're spending less than you earn, you're saving the difference, and you're delaying gratification today to buy your freedom tomorrow. But what if the measuring stick that you're using to track that freedom is broken? Consider this. Since the creation of the Federal Reserve, the US dollar has lost over 96% of its purchasing power. But that's just the history. The reality today is even more urgent. We are living in an economic environment where saving is often punished and speculation is encouraged. We see stock markets at all-time highs and home prices that have doubled in a decade, and we're told that this is quote-unquote wealth creation. But my guest today argues that this is a dangerous illusion. He believes that we're witnessing a systematic wealth redistribution, a mechanism designed to transfer value from the prudent saver to the indebted state. He calls it a beggar thy children policy that keeps zombie companies alive, inflates asset bubbles, and fundamentally confuses money with actual capital. If you're basing your financial independence on a number in a bank account, you need to understand the forces actively working to erode that number. Think about it through the lens of a program manager. Imagine trying to execute a 30-year program where your budget shrinks 3% every single year, regardless of how well you manage it. You could have the perfect plan, the perfect timeline, the perfect discipline, but if the unit of account, the money itself, is broken, the project fails. It's like trying to build a castle on a slow-moving sinkhole. We are told that inflation is necessary for growth, but in reality, it is often just a transfer of wealth from your pocket to someone else's. It is a system failure that redistributes rewards from those who produce to those who consume. So how do we engineer a portfolio that survives a currency that is designed to lose value? That is one of the questions we're going to look to answer today. And today's guest is here to help us figure it out. I am joined by Paul Musson, the author of Capital Offence, Why Some Benefit at Your Expense. Paul is a veteran investment professional with over 30 years of experience. He formerly led the Ivy funds at McKinsey Investments, managing over $10 billion in assets. And today we're going to discuss why inflation is not a weather pattern, but a moral crime, why your net worth might be a vanity metric, and how to build a defense strategy that prioritizes true wealth over fake money. Paul, welcome to Escape the Clock.
Well, thank you, Daniel. Great to be here. And that was one hell of an introduction, I must say.
Well, Paul, I'm actually really excited for this conversation because I was reading your book. I was just learning so much about so many things, and I really can't wait for the audience to start to get some of these insights. But before we jump into some of these things, you used to manage billions of dollars, and you've seen the system from the inside at some of the highest levels. What was the tipping point that made you decide to stop playing that game and decide to write this book that exposes so much of it?
I don't know that there was a specific tipping point. I think it was an accumulation and a slow awakening on my own part about what was really going on. And I've always lived well, not always, but a great deal of my life I've lived with this face the music type attitude. Don't kid myself. Don't stick my head in the sand. Consider second or third order consequences, because I was realizing what the consequences of not living that way were. that you could get away with something in the short term, but then it'd come back to bite you. And I didn't want it to come back to bite me. And so I started living my life that way long before I became an investor. It was like an intellectually honest approach to living my life. We could talk about that as well, but that's the real journey. That doesn't happen overnight either. It's an evolution over time. And then in part, it was because the way we invested, and my team still invests, that investing, as an investor, you play a very important role in helping to facilitate the efficient allocation of capital in the system, in the economy. So as an investor, like you just said, that, our clients would earn some money, create capital, they'd consume some of it, but then they would save the rest for their future financial security. They would hand over, or they would give their money that they saved to us. And our goal was to augment what they had already done, not a get rich quick scheme or, no, we're going to help you to grow that a little bit, protect your capital. And the way we would do it would be by allocating it to who we thought were some of the best businesses in the world. The best run businesses are going to put that capital to productive use to create more capital. This is the way the system is supposed to work. A free market capitalist system. You only benefit to the extent that you're benefiting somebody else. You create capital, you freely exchange that capital with the capital that they produced. Increasingly, we are moving to a benefit at the expense of somebody else, which we'll talk about. And I'm getting around to answer your question. So if everybody's doing that, if we're taking the capital, making the best assessment that we can, okay, that company is a basket case company. They're going to destroy and consume capital rather than create it. Well, guess what? You don't get any capital. So you starve these zombie basket case companies for capital, and eventually they go out of business or they fix their business model. They're incentivized to change. But if the central banks come in and bail out Wall Street from very bad decision making, then the system stops working. And it encourages more of the very same type of behavior. It encourages even more risky behavior and more leverage because they know that the Fed will come to the rescue with taxpayer dollars. And they do that by printing money.
Yeah.
And we can talk about the mechanism, actually, how that actually works. So that sort of got me angry. Then you saw productivity growth grinding lower. The more this happened, more people are suffering from this, but they don't even know that this is why they're suffering. Because while central banks are driving stock markets and housing prices higher, isn't that good for the economy? No. Stock market should only be going higher if the underlying businesses are producing more and more capital. More capital being produced pushes stock markets higher. The Federal Reserve decided to do the opposite and drive stock markets higher and try pull up the economy with it and hope that the benefits would all trickle down to everybody else. It didn't work and it won't.
The M2 money supply exploded by 40% between the years of 2020 and 2022, where the Federal Reserve economic data then showed that productivity barely budged. Like almost no productivity increase, yet the supply increased almost 50%. That's a massive disparity.
Yeah.
One thing that I noticed is before I really got into investing and digging in and understanding and educating myself, I was pretty naive. I assumed anything on the stock market was some productive company, everything would provide capital and value. And the more I would research investments, the more I would learn there are a lot of zombie companies out there, a lot of just these companies dragging along. And like you mentioned, so I want to get into this a little bit more though on the money versus capital piece, just to help the audience understand the nuance here. Because a lot of time, I think we do inflate these things together. For someone building a nest egg, why is focusing on the accumulation of currency itself actually a trap? And how should they start to shift their mindset to focusing on acquiring true capital instead? And maybe start with the difference between money and capital in your mind.
Yeah, I think I'll start there because it makes it easier. So, yeah, a lot of people conflate capital with money. They're two very different things. It's the creation of capital that makes the world go around, not money. Money is extremely important. But all that money is there for is to exchange all the capital that's being produced. So capital can be anything that you produce that somebody else values or you yourself value. It could be a good or a service, your podcast, you're creating capital and your listeners are consuming it. So the example I like to give is you make a bike. You just created capital. I make a suit. I just created capital. And then we fairly exchange the bike for the suit. That's called direct exchange or barter system. Importantly, none of that came at anybody else's expense. There was no bike and suit in the economy. And then we both used our resources and our work ethic and we created that and exchanged it with each other. No one was coerced. But we don't do direct exchange. You can't have a large economy with barter. It just doesn't work. It's too complicated. How many kitchen chairs does it cost to take a flight to Florida? You can't work that way. So we use a medium of exchange called money. So it's indirect exchange. So you would make your bike, you would sell it for $1,000. Let's say it's a really nice bike. And then you would use your $1,000 to buy the suit from me. Indirect exchange. So the difference between capital and money. You can have an economy with capital and no money. You cannot have an economy with money and no capital. If you've got money, you got no capital to exchange, So let's say you make 10 bikes. You sell them for $1,000 each. You got $10,000. You put that in your bank account. You don't spend it right away. You're saving it because you might want to go on a nice vacation at the end of the year. But before you get a chance to spend your $10,000, the central bank doubles the money supply. Now, when the central bank doubles the money supply, what they do is they just create money out of thin air, either digitally or they print it, push a couple of buttons. They did not have to create any capital to obtain that new money. So that new money has no capital stored up in it. Your $10,000 that's in your bank account, effectively what that is doing is storing those 10 bikes that you produced. That's what gives that money value, right? So now the central bank prints money out of thin air. There's no capital in it, but it obtains capital as soon as it enters the economy by extracting capital from the rest of the money already in existence. So as soon as that new money comes into circulation, it takes 5 of the bikes from your $10,000 and puts it into the newly printed money. So your bank statement says, oh, great, I still have $10,000 in the bank. Well, guess what? It's only storing 5 bikes instead of 10. So now your $10,000 will only buy half as much as it would have done before the central bank doubled the money supply. That's the difference between capital and money.
When we were on the gold standard, we had a more, at least a harder to game system, right? We had an actual resource there that we could know was sitting there that we could exchange against and stuff. When we went to the fiat system, it seems like, at least in your book, I started to get this understanding that that's when the hole started to be really dug. And now that we can just kind of have the central banks printing money, they'll just keep doing this because their incentive is to keep showing growth at all costs, no matter what. In your mind, is moving to digital currency the next big step for them to dig even further at this point? Is that how we should look at that?
Well, it depends on the structure. They could move to a digital currency, and as long as they didn't increase the money supply at a rapid rate, that would be completely fine. The trouble is that I don't think they have any intention of doing that. And if they move to a digital currency, it could be an even greater invasion of your privacy and your property rights. Now, don't get me wrong. I don't think it's a conspiracy theory, and I don't think these people are evil. I really don't. I really think that they believe, or at least they've convinced themselves, that what they are doing is the right thing for the greater economy, for the greater good. It also makes them look good, right? That they can spend more money. They'd be convinced by certain economists that deficits and debts don't matter. They do. They matter a lot. But it's easy to convince yourself that taking the easy path is the right thing to do. And so, unfortunately, unless something changes, either a broader understanding or a crisis, then moving to a digital currency could make things worse.
A lot of people here, myself included, track net worth. If you're in the United States, you're tracking it in US dollars. Is that just tracking inflation rather than our real purchasing power? And is nominal net worth just a lie? What metric should we be really thinking about using instead? Some kind of hard asset, something else?
Well, it depends. So let me back up. So policymakers like to point to record household wealth in America. And that is driven largely via soaring stock markets and soaring house prices. But if stock markets are soaring because of interest rates being taken to zero or the central bank printing money and buying assets and just announced that they're going to be buying treasury bills again, then that's not real wealth creation. All it is the price you have to pay for that wealth has just gone up. There's no more capital in society. But if you are fortunate enough that you have assets and the central bank drives the nominal value of those assets higher, and then you sell those assets for money and then you could invest them in real assets or whatever and try and protect you, you've benefited at the expense of somebody else. You haven't done anything wrong. You haven't done anything illegal, but there's no real wealth creation happening there. So, and there is a lot of real wealth creation still happening in the economy, don't get me wrong. But another example I use is, let's say you've got a desert island and there's 3 houses on the island and they're all priced at $400,000 each. And then one person sells one house to the other for $500,000. And then the other sells that for $600,000. And they keep selling the houses to each other at higher and higher prices. Well, you had 3 houses at $400,000. Net worth on the island was $1.2 million. But now if they all sell the houses to each other for $1 million, household wealth has just gone up to $3 million. Despite the fact that you still only have 3 houses. No capital was created. But this is what lowering interest rates does and printing money. It creates fake wealth in the economy, fake wealth creation, but real wealth redistribution.
Yeah, I'm glad you brought that up because that was probably one of the hardest things to read in the book for me was, like yourself, you admitted it in the book, and myself did well with owning a home. Generationally bought in, had a lot of debt there, but really stuck with it. And home values have just continued to go up and up and up. And what incentive do you have to sell your home necessarily when a lot of people who haven't bought it yet are being able to maintain very low interest rates? They don't have a lot of incentive to go take a higher interest rate and lose this appreciating asset. And others who have just really benefited from this increase in wealth for doing next to nothing, really, just sitting on this thing. Now, I put some work into my house. I tried to improve it in certain ways. But your point really is you wouldn't really have to do anything. Just the way the market's designed right now, that real estate asset will appreciate and you will benefit from it. And what that's doing is locking out the next generation or immigrants or others from being able to have access to that wealth. That was fascinating, but also kind of hard to read. How do you see that situation? And is it just an interest rate issue? How can we stop blocking this housing crisis from continuing for the next generation?
Yeah, so it started with interest rates, but then other parties piled on to make it even worse. So we'll go back to 2001. So the US had just gone through the dot-com boom and bubble. And there was lots of great things happening, right? The internet.com is super exciting, new business models. A lot of them were basket cases, but a lot of them ended up being like real wealth generators, and there was real productivity growth going on. But everyone got carried away, as they usually do. Anyway, so that was creating a real wealth effect, or partially real wealth effect. Stock markets going higher. Greenspan used to talk about this. He was the head of the central bank at the time, the Federal Reserve, and how much the stock wealth effect was contributing to spending in the economy. And so GDP was growing higher because stock markets were growing higher. Then the whole thing crashed. And then you had people like Paul Krugman of the New York Times and Paul McCulley of PIMCO, commentators, well known, suggesting that the U.S. Federal Reserve should create a new wealth effect in the housing market because more people own housing assets than stock assets. And this would have a greater impact on GDP. People would borrow on the rising value of their home and go spend it. GDP is a measure of all final spending or consumption for the most part. It is not the fount of economic prosperity, which we can talk about. So anyways, they started driving housing prices higher with record low interest rates at the time. Greenspan took the Fed funds rate down to 1% in an economy that was still growing. That would normally be in emergency levels like depression or war. But no, because they thought it was good for the economy. A house has no business increasing in price because a house is not producing stuff. So earlier we were talking about how you created a capital via a suit and I created capital via a bike. My wife and I bought our home here in a suburb of Toronto in 2001, right when these policies started. And then the Bank of Canada followed suit, and the Bank of England and the European Central Bank. So our house today is worth 4 times what we paid for it. It's in nominal terms. In real terms, it's like 2.5 times or something. So if in a capitalist system, you're only supposed to benefit to the extent that you benefited somebody else, whatever real wealth you have is supposed to be a reflection cumulatively of the wealth that others out there have because of your efforts. And you fairly exchange through the medium of exchange called money. So if our house went up 4 times in value, what was our contribution to society? Who else out there is also 4 times better off? No one. In fact, they're 4 times less well off. Our house is not producing 4 times the amount of stuff that it produced back in 2001. It hasn't increased 4 times in size. It hasn't relocated to a glorious oceanfront view in Palm Beach or something like that. It's the same economic good that a younger couple or a newcomer to our country is forced to pay 4 times more than we paid for it. When you look down on society, when we make 4 times on our home, there's not 4 more homes. There's just a redistribution of wealth from a younger couple's bank account into our bank account. That's it. And it's unfair. It's immoral. It wasn't the goal. It wasn't the intention to create a housing affordability crisis for the next generation. I don't believe that at all. But it is the result, and it was so predictable.
Yeah, I think this is why that was hard to read for me, and maybe why others might have a hard time with this, because a lot of us just have good intent here, right? We're thinking we're doing the right things. We're trying to buy a home. We're working hard. We're putting our hard-earned income into that, trying to build equity. But indirectly, we're contributing to a housing crisis, right? We're contributing to wealth prevention for another generation. That's tough. You know, in the United States, since 2009, the U.S. house wealth has nearly tripled to $150 trillion, which has largely been driven by asset price inflation, not GDP growth. So this is a pretty significant number we're talking about now. So I guess to follow up on that, should I even think, or should the listeners here even think of their primary residence as an investment? Or is it better to view it as a consumption expense and just be more honest about it?
Well, if central banks continue with this policy, with attempting to drive housing prices higher and taking actions to prevent them from falling in price, then I think you should continue to factor that into your wealth. I think, on the other hand, I think being aware of how we have obtained that wealth is very important, because it could go away at any time. And now the reason I say that is because our current path is not sustainable. It's not sustainable when a whole generation is priced out of the standard of living that they deserve, that they've played by all the rules. They're better educated than I am, that's for sure, willing to work just as hard. They can't dream of affording the same sort of lifestyle that I was able to afford. And so they will not put up with it, and they will demand change. You're seeing this in New York City with a new socialist mayor, and that will continue across the country. And so we can either decide to change it ourselves and make it fairer, such that this won't be the first time in modern history that the next generation will be worse off than the one that preceded it. So we can change it, or they're going to change it for us. But again, it's, to your point, it is tough. It is tough to acknowledge this. And I'm 63. And, when I tell my friends and family this, first they don't really like it, but they get it. They get it. And they don't want their kids to suffer at their expense. Although every now and then I do run across somebody who not only doesn't like it, but refuses to see it because they don't want to see it. And I understand as well, because the whole life they've been living to get on the housing ladder and blah, 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 just like my parents did. And yeah, you haven't done anything wrong. I'm not blaming anybody. Nobody's a villain here. It's just a bad system. And there's a saying by Upton Sinclair. He was more of a left-leaning politician back in the 1930s. And he said that if someone's income depends on them not understanding something, don't expect them to understand it. It's not that they can't. They don't want to.
Yeah. The way I look at it is, if we can't take the time to understand the system, how are we going to improve it?
Exactly.
So I do think this is where this starts, is with these conversations. Let me ask you about the other big hidden tax that you really touch on in the book. You described inflation not as this kind of natural pattern or weather pattern, if you will, but as a deliberate mechanism of confiscation. That is essentially a hidden tax on people who are acting prudently, the savers and everyone. And a lot of people here, we are savers, we are investors, we are doing what we can to hit financial independence so that we can have the option to enjoy our lives to the best means that we possibly can. So because of this hidden tax to inflation, I'd love you to explain it more to the audience about how that works. And also, does that mean that the traditional path to financial independence, which is saving a portion of your income, is that, in your mind, broken by design?
I don't think it's broken by design. I mean, an economy cannot function without saving and investment. It just can't. Yet, I guess it started with an economist called John Maynard Keynes back in the 1930s. And it was in the middle of the Great Depression where he convinced politicians that it was effective demand or consumption that is required for an economy to really function, that demand drives economic prosperity and consumption. No, it's not. It's saving and investment. And saving and investment, you have to do that first. Create capital. You create a suit. That suit then gives you the wherewithal to go out and buy my bike. But you had to create a suit first, right? So, but they've tried to turn that around and convince people, governments, that consumption comes first. And if they need to print money to give to people to consume before they produce, then that's what they will do. But what that does is it redistributes capital within the system. So it does take capital from your savings and gives it. So if you refuse to spend your savings on a new bike from me, and instead you want to save your capital to create more suits, then the government will print money and extract capital from your money and give it to someone else so they can buy my bike. They've convinced people that if people aren't worried about higher prices in the future, that they will refuse to spend. It's complete and utter nonsense. They call it the paradox of thrift. So if prices are falling, let's say the price of my bike is going down 2% per year, policymakers will believe that you'll refuse to buy my bike because you're just going to wait a year and buy it at 2% lower price. No, it's not true. So the example I use in my book is if you want to buy a TV, you've already got a TV, you want another TV. So it's a real luxury for the basement for your teenage kids. So it's $300 and there's 2% deflation. So central bankers believe that you would never buy that TV because you just wait 12 months to buy it 2% less. So your choice is you can buy the TV now for $300 or wait a whole year and save $6 and buy it for $294. Are you going to wait a whole year? No, you're not. By that logic, people wouldn't have bought flat screen TVs because they've been declining in price for years, right? People just continue to buy them, buy more of them, and a falling price. It's called good deflation. This should be the natural order of things in an unhampered economy. So what happens is companies, let's see, TV is a great example. So back when they first launched flat screen TVs in the early 2000s, they were like $3,000 or something. But then the companies that are producing them, they reinvest product innovation, R&D. They're able now to produce those TVs cheaper. So it's still $3,000, but because they're producing it cheaper, the cost has gone down. They're making more money. That higher profitability attracts competition from other players. They enter the market and compete, and the price comes down. Then they reinvest and learn how to make it cheaper. The profitability increases. More competition comes in. The price comes down again. So when you have innovation, productivity improvements, as well as competition, you need both, then prices continuously fall over time, as long as the money supply is not increasing, and the ultimate beneficiary is the consumer. So even if you are a flat wage, your wages don't increase, every year you're becoming wealthier in real terms because your flat wage is buying more and more stuff. The last 30 years of the 1800s in the US, that's what you had. It was such a productivity boom. The money supply was only increasing 4.5% or something per year. I mean, I don't think even should be even rising that fast, but that's fairly slow by historical standards. That the amount of stuff being produced in the economy was growing faster than the money supply. So there's more and more stuff and less money. So the prices of the stuff had to come down.
Naturally, yeah.
You know, that's good deflation. That should be happening. But instead, we pay more and more for everything, not because stuff is more expensive to produce. No, companies get more efficient at it every year. But the governments increase the money supply at a rate faster than the economy can produce the amount of stuff. And that's why you're paying more for everything. It's not the natural state of things. The natural state or natural order is the opposite.
People feel the economy.
Oh, yeah.
It's always a top issue. We see the pendulum of political parties in the United States swing back and forth because of the economy. People on some level feel this.
Yeah.
They know that they're not able to buy as much, but when they're at least at the grocery store. But I don't think everyone understands exactly what that means. I think a lot of people, if you ask them, well, how do you fix this? They're like, I need more money. Pay me more money.
Oh, yeah.
They don't think about their spending power from a point of deflation. How do you think just an average person who, at least in the United States, that gets no financial education will be able to come to terms with some of these things? Would this just is systemic change at a government level enough, or is this more just an education issue as well?
So I think that the education has to come before a systemic change can happen, because I believe the systemic change will only occur when the people demand it. Now, there's a saying that the people always get the government that they deserve. Like, you voted for them, so stop complaining. Well, no, it's only true if the people actually understand what's going on. If you don't understand what's happening, you can't demand the right things from your policymakers, from your leaders. And so for a few decades, we've been demanding the other thing. We want free stuff. As I said before, like in the economy, what you have is supposed to be a reflection of what you've produced. And so if you're taking more from the system than you're contributing, it's coming at somebody else's expense. There's no ifs, ands, or buts about this. You just can't see who that is. And so it's easy then to convince ourselves that we deserve it and all this kind of nonsense. And so once people understand what's going on and the path that we're on is not sustainable and that we are benefiting at the expense of our kids, then we will demand different actions from our leaders, our politicians, and then they'll do it because they're good people. They want to do the right thing. But to do the right thing today would be political suicide because nobody thinks that you're doing the right thing. Hey, how come we don't get all this free stuff? Okay, let's vote this guy out. And I do believe that. I do have great faith in people. Most people are good people. Most people want to do the right thing. I truly believe that. And they will want to do the right thing. And the thing I love about America is this can-do spirit where you guys rally to the cause. It's amazing what Americans can do. But importantly, the people have to know that they're all in it together. And it's not just a few people who have to make the sacrifices and these other people over here are going to make off like bandits. No, they have to know that we're all in this together. Let's do this. Let's fix this. Let's do whatever it takes. Let's not stick our head in the sand anymore. And so I believe it can happen. It won't be fun,
No, it never is. As you're talking about that, it reminded me of when Paul Volcker was doing his very unpopular decisions to end the great inflation that was happening in the early 80s and how everyone just thought he was crazy for what he was trying to do. Yet history has shown that was exactly what the economy needed. And we need more Pauls. That is my conclusion here.
Yeah, that's right.
This is what I think. So, but I think you mentioned him in the book too at one point.
Yeah, I think he was the greatest central banker of all time and willing to do the right but unpopular thing. And, it's sort of a long story, but the previous head as well, Burns, I think his name was, he also increased interest rates, but not enough. And the trouble is that no matter how high they increased interest rates, banks were still, or people were still borrowing because in real terms, the rate was still very low or even negative. And so Paul Volcker I think he pivoted course and targeted the money supply instead of interest rates. Anyways, in today's environment, there is way more debt outstanding than there was when Paul Volcker took the Fed funds rate all the way up to, I think, to 20%. Can you imagine? And mortgage rates were up in the high teens, I think. If you did that today with the amount of debt outstanding, I don't know that you could do it. Maybe. But this is the problem. The problem is that policymakers have encouraged debt-fueled consumption on the part of consumers, but also government debt-fueled spending. And with the US now at well over 120% debt to GDP, there are certain studies out there that will tell you that once debt to GDP gets over 90%, that future economic growth is permanently harmed. That you should expect slower economic growth because you've got this debt anchor on your back that is slowing the economy down. I mean, just like you with your clients and your listeners, you caution about the hazards of having too much debt. But the problem is policymakers and some economists will say, what's right for an individual is not what's right for the broader economy. It is, but they will tell you that it's not.
There were a couple things that I just thought were fascinating when you were talking about it in the book. One was you described kind of the economy like a tumored patient. And how the debt system is like this growing tumor that just needs to really be surgically dealt with. But the real medicine to heal the patient would be recession, like just an actual natural painful healing process. And instead, it's just easier for the government, maybe central banks, just to go to stimulus.
Yeah.
And, just pump drugs in there and stimulate the patient and keep them kind of going along. Fascinating way to kind of point that out. But I mean, I can see why that's a hard sell, right? You want to go and say, look, we're just going to go deliberately into a recession so that we can deflate. So your purchasing power is where it properly should be again, and we move away from a leverage-based debt system that's so bad for so many people. But what's the alternative? Right now, all I see is the amount of debt in the United States. It's just staggering. Both the government, because it can just kind of just continuously print money for itself and borrow without, worry, and just consumer debt. I mean, I think it should be criminal personally, the interest rates for borrowing and the ease of borrowing. I was at a retail store just buying something for my daughter. It was like a $70 purchase, and I was pushed for a good couple minutes to get a retail branded credit card to save a small percentage on that amount. And I tried to spend that time telling the cashier why that was wrong to push those cards. But their incentive is to push it. They're told you're going to get commission for doing this. And their whole sell is you're going to save $10 today. Why wouldn't you do it? Your credit's probably bad. They'll deny you. So no harm done. You save $10, right? Well, yeah, but your credit was already ruined. You're not making it better by applying for more cards. So, people peddle this and it becomes very predatory in a way. So I'm just curious, when the cure is so painful, how will we get out of the situation?
Well, a couple of comments first on that. Policymakers think that people need to be encouraged to consume. Nobody needs to be encouraged to consume. If anything, we need to be encouraged to save more. Right? The consumption is not the issue. It's too much consumption is the issue. And the other thing is, recessions are necessary, but they're not, as some people claim, a punishment. Oh, why? Oh, you want to punish people because there was a bull market or there was a bubble? No, it's not about punishment. It's about fixing things. So the analogy that you alluded to in my book, it's like if you have a tumor and you go to the doctor and the doctor says, look, I have to operate on you and remove the tumor. It's going to result in 18 months of rehab. And so economically, it's going to be pretty rough for you the next 18 months. Is the doctor punishing you? No. He's trying to help you, trying to heal you. And so, anyway, get that out of the way. In terms of, because it will be painful. It will be more painful for some than others. Now, some people have benefited enormously from this situation. Fiat billionaires, some people refer them to. Now, these people, if your wealth goes from 50 billion down to 2 billion, are you really suffering? If you're worth 500 million and your wealth goes down to 200 million, are you really suffering? I don't think so. Might be embarrassed. Maybe they're embarrassed. I don't know. But it will impact other people, particularly people who recently bought their first home and at near all-time highs. And if the real price, intrinsic value of homes is half of what it is today, then these people are unfairly punished. It's not that the price shouldn't go down to the intrinsic value. They shouldn't have gone up to the bubble price in the first place. That is the issue. So it's not their fault. So as a society, I think we're obligated to help those people. We're not going to help the Fiat billionaire because they're only worth 2 billion now, but we're going to help the younger first-time home buyers who just lost money in their home if they have to sell it due to no fault of their own. So people like me who've made fortune, but have made good money on my home, got to be careful. And if we sell it, maybe part of the capital gain is taxable. Whether it's 10%, 15%, 20%, and it's only on capital gains above a certain amount. So for people who all their life have been believing or thinking that they can rely on the capital gain on their home to fund their retirement, you can't all of a sudden just take that away from them. Now, if the price comes down, you're not going to get all of it. But the alternative is to continue to punish the next generation. That if you understand that, yes, I was counting on this all my life, but I didn't realize that it was coming at the expense of somebody else, then it makes it easier to take. A house is not supposed to be an investment vehicle. It is a savings piggy bank. It's like, as you know, it's like a method of forced saving.
Yeah, a liquid savings. Yep.
If you buy a home with a mortgage, you're forced to pay your mortgage off. Otherwise, bank might come and take your home. And so, and then when you're finished, you've got all this equity in your home. But this equity in your home is a reflection of all the bikes that you made throughout your career, and you sold those bikes and used the money to pay down the mortgage. So your house, the equity in your home, you've got all these bikes stored up in your home. But if the central bank drives the price up 2, 3, 4 times, you've got your bikes, plus you have nursing services from this young couple over there, plus you've got flight attendant services from this young person over here. You've got their capital stored up in your house as well, which they have to fork over money if they want to get that capital back.
Yeah, we've all become pack rats for capitalism.
Yeah, listen, there are no easy answers here. I'm not here to tell anybody that there are. I'm just here to try and explain to people what's been going on and why, and what I believe we need to do to fix it. And the understanding is step one.
You do a wonderful job of it in your book, actually. And I actually could talk to you about this all day.
Thank you.
You do a very good job just outlining the problem and educating people on kind of how we got there. And I mean, you're kind of blunt with some of it at times, but you had a pretty optimistic message at the end, which I liked.
Yeah.
But let's get into some of the practical stuff. And I know you're not going to have answers for everything here, but I would love to get your thoughts on some of these issues, because these are probably on people's minds right now when they're understanding the problem a little bit clearer. For instance, my listeners might be thinking about withdrawals. We save so that we can live off of those savings in the future.
Yeah.
And a lot of people live by this idea of a 4% rule. This idea that they're going to withdraw 4% inflation adjusted for the rest of their years, or at least long enough to get to some kind of retirement accounts. Is it a safe withdrawal rate? Considering that a lot of people look at CPI or just inflation numbers, how safe is it really when we calculate this burn rate based on this data, which is based on inflation, based on all of these problems we talked about?
Well, it depends on what happens. No, honestly, it's, as a professional investor, we would always remind ourselves that we didn't know what was going to happen. And we also know that nobody else knows what's going to happen, even though there are lots of people out there with opinions with respect to what they think is going to happen. And there's a lot of smart people, a lot of smart experts, and it always sounds convincing. Then you can hear another person say the exact opposite. Oh, that sounds convincing too. Nobody knows. And so the way I've always approached my investing style and my savings and spending is assuming that something bad could happen one day, but it might not. And so I'm going to strike that balance of probably not spending or withdrawing as much as I possibly could if things were rosy forever. But if things do get really bad, I'm still going to be okay. And if things are better than I expected, well, that's a bonus and I'll spend more in the future. I don't know any other way to approach it because I don't know what's going to happen. And it, as you know, it all depends on your own risk tolerance. People are different. Now, could I share with you one story with your listeners?
Please.
It's somewhat related to this, but I'm just thinking you just triggered my memory. So my clients over the years were financial advisors. So stockbrokers, financial planners, lots of amazing people, like really providing a really amazing service for their clients. And as you know, as you said, it's important to forego some consumption today, save some money so you can spend in the future. And so we're trying to get people to be disciplined to save and not consume all your money today. So this one advisor in London, Ontario, which is not too far, like an hour and a half from where I am, and it's a lower cost living area, it's a nice area, but not like in a big city like Toronto. And so she said, let me tell you about this client of mine. He was an East European. I think he worked in the car, like in the assembly factory, but an amazing saver. And he was in his 80s, passed away. His wife now is coming to see the advisor to see about the state of the finances, and she has no clue, right? Because he did everything. It was back the way. And she was so excited for the client to come because she was going to tell her all the good news, right? So client comes in. She says, okay, first of all, no mortgage. Your house is paid off. Second of all, you've got over $1 million in the bank account. You're not going to have to worry about anything for the rest of your life. Her client starts crying. And the advisor says, well, what's the matter? Why are you upset?
I think I know why, but go ahead.
He said, all I ever asked for was 2 weeks in Florida. Wouldn't spend the money. And so you got to strike that balance. So my wife and I, one of our favorite sayings, and we've been married 33 years, is life is happening now.
Awesome.
Don't wait for a better life in the future, but make sure you're saving so you're going to have a good life in the future too. Just striking that balance.
Thank you for saying that. I think that's very important. I had to go through that journey myself. I realized at one point my optimization technique was frugality to the point where I wasn't enjoying my present. And luckily I have a very supportive spouse who kicked me in the line there. And together we figured that out. But yeah, you're absolutely right. You can't sacrifice to the point that you're miserable. It's about smoothing out your life, enjoying your present and having the future you want. Then next question I have for you is closer to investing, because a lot of people will look at investing as that accelerant to being able to have enough money in the timeline that they want to have it. And you had described in your book the economy as a functioning alcoholic, dependent on cheap money that was just kind of keeping these zombie companies going. So for a passive investor, I know a lot of passive investors. I've actually helped a lot of people get into investing, and we'll say, okay, go into these index funds. But you surprised me. You made a point about, hey, look, when you're buying into these index funds, and again, for anyone who doesn't remember, I have a whole episode on this, but index funds are going to be buying into a broad set of stocks, right? More than one company. You're buying into many companies, but you're knowingly subsidizing some failing companies in this set, well, very likely, which is weighing down your returns. So that's really interesting. So in a way, you are contributing to keeping zombie companies alive through some of these index funds. Do you feel like people's investment strategies should shift, or is that just part of the situation we're in?
Well, I would say that start by saying there's nothing wrong with index funds and the whole idea and the concept. And in fact, for a lot of people, I think it's a very good vehicle. It's not a good vehicle if index funds start to overwhelm the capital allocation mechanism within the markets, because you have they're price indiscriminate. And so they're not looking around the world for who are the best allocators of capital. They just buy what's going up. Now, I mentioned Michael Green in my book. He talks about how the largest stocks in the index benefit inordinately from passive investing. And the reason is, so if you have $100 goes into a passive fund and Microsoft is 5% of the index, well, Microsoft gets 5% of that $100 or $5. But the trouble is that the liquidity of the daily trading activity of Microsoft is what they call inelastic compared to the market cap. So the liquidity might not be 5 times what a stock that's priced at $1 is. And so the impact on the share price is much greater when that $5 comes in to buy Microsoft. So anyways, but it doesn't mean people shouldn't buy index funds. I think people should just be aware that a lot of the stocks that they have that they're invested in are very expensive. Yes, they do hold basket case companies in their portfolio, but for the last 20 years, it hasn't mattered. And it may not matter for the next 5 or 10 years if the central bank continues to come storming back by printing money to drive those asset prices higher. So they could continue to benefit from that. But these actions do inordinate harm to the functioning of the economy. It distorts the price discovery mechanism of markets, keeps those zombie companies alive. So companies like Microsoft, they're amazing companies. There's no question about this. It's just the price that you have to pay for that amazing company keeps going higher and higher and higher. So there's no more, the price is not reflecting more capital that's being created. It's reflecting the fact that passive investing and central banks are driving those stock prices higher.
Well, and just like the housing market, that's pricing a lot of people out too.
No, exactly.
I know a lot of people, like my son included, finally got interested in investing in some of the stocks he was interested in, he couldn't afford.
Yeah.
So he felt like it was a barrier, which was kind of sad. In your book, you do outline solutions. You talk about, look, this is even how the system itself could be fixed. Now, of course, myself and listeners, we're not going to be able to fix the Fed. But all we can control is how we live our own lives. Now, of course, educating ourselves is important. But we also need to figure out what personal defense measures we need to put in place for our own financial security. So in a world of fake wealth and zombie companies, how do you see equality as part of the strategy when it comes to the ultimate safety net? Kinds of things I have in my mind would be things like cash flow and looking for, quote unquote, maybe honest money assets like gold. Yeah. You mentioned gold quite often in the book. Do you look at that, for instance, as a safety net that someone should be putting in a financial freedom plan?
So I have gold in my personal portfolio. It's a percentage. Call it my sort of central bank lunacy hedge. And if they really go nuts, some policymakers will say that financial repression is the only way out of this, which is a really bad thing, by the way. And so you will be financially repressed and the governments will inflate their way out of the debt problem. And if they do that, then having gold probably be a very good hedge. No guarantees. But if they don't do that, if they actually try to fix the situation, price of gold could get cut in half very quickly.
As part of the solution, is what you're saying.
Yeah. Well, yeah, because people won't feel that they need it as a hedge anymore, that other foreign central banks won't feel that they need to hold gold if they can all of a sudden start trusting the US dollar again. That's the main issue. And so, but I don't know, like I said earlier, which one it's going to be. So I'm going to hold some gold. I'm not going to have a whole pile of gold and tell everybody got it. And then, if it doesn't work out that way, And so it's just striking a balance, having diversification, having some real assets, a house, property, have some gold. I've invested in the stock markets. I've got some cash and some high interest savings accounts and stuff like that. I'm very defensively postured. And my equity investing is through my mutual funds that I used to run. So my old team, they're running it. And I know exactly what they're doing. Very high quality companies with strong balance sheets. And that's just me. I'm a worrywart.
I am too.
A bit of a worrywart, in part because I see what's going on out there. But, you lose hair when you worry. So I used to joke with my clients that the name of our funds was Ivy. So my motto was, at Ivy, we lose hair so you don't have to.
Yeah, that was great to hear because I have a very similar defensive posture. I look at diversification, sure, but I also diversify my hedges, right? And I try to think about how do I imbalance some covariance on each side as far as possible. So it's great. I think that's really helpful and useful for the listeners to think about because, again, can't really change the system outside of understanding the system, pushing for and speaking up, but doing those kinds of smart moves can help protect stuff. So despite the capital offense that you've outlined so clearly, you did, like I said, come off pretty optimistic in the book. So if we are able as a global societies to fix money, what does the future look like? How would we live in a system like that?
Well, I think we would thrive. We would thrive if we had honest money, hard money. If what you had was only at least a closer approximation of what your contributions were. So first of all, people would be happier because it would be a much fairer system. Wealth inequality would not be nearly as wide as it is today. There would still be wealth inequality, as there should be, because it's based on your efforts and your contributions. Your bike shop, you make 10 bikes a week, and I decide, well, I only want to make one suit a week because I'd rather goof off or whatever, then you should have more wealth than me. But it's not coming at my expense, right? There would be much less debt. The price discovery mechanism of capital markets would no longer be distorted, and so you would have much more efficient allocation of capital. There would be way more stuff being produced, way more innovation. Companies would be encouraged to invest in their businesses rather than their share price. Rather than taking on debt and buying back shares to drive the share price higher, they would use that capital more in their own business. And again, don't get me wrong, there's still lots of great things going on in corporate America, but there's a lot of bad things going on too, and a lot of bad incentives. I think Charlie Munger used to say, he was Warren Buffett's sidekick, show me the incentive, I'll tell you the behavior, whatever. I got one quick story, and it's just an example of what it's all about. This is capitalism. This is like where all the constituents benefit. People think like success is just the senior executives and the shareholders benefiting. Well, if that's what's happening, that business model is not going to last very long. And that's what you see out there often. But there's a lot more of the other stuff going on. So Fastenal, they're based in Minnesota. They make fasteners, screws and stuff like that, distribute them and stuff to them. So not the most exciting business. We went to visit the plant. We had a tour of the plant. And they're so excited. The plant managers, check out these screws. Our clients love us. And I said, what the hell's going on here, And so I asked the guy, I said, why do you love the business so much? And he said, well, it's management, ownership. They treat us like partners. They ask for our opinions. And it's not just lip service. They implement a lot of our ideas. And importantly, they all share in the success of the business. The more profitable the business is, everybody benefits. That's the way it's supposed to be. So then he said, so we walked, I forgot to tell you. It's a great example. So the CEO was the founder. He owned about a third of the company. His wife also had a good stake in the business. She'd passed away a few years earlier. After she passed away, the CEO took all of her shares and distributed them to all the employees in your company.
Wow.
That's what it's about, right? And founders are often this way because, he started the business from the ground up. So he did every job that everyone in that company is doing now. So he's got more empathy for what they may be going through. And, versus you get these career executives, again, not bad people. And I've met some amazing career executives, but they're more financially driven.
Right.
They've never had to start a business. They don't know what it's like to be in the back sweeping the floor and closing the shop up at the end of the night and committing your own capital and worry about it. But, if you have honest money, and you don't have the threat of central banks bailing out bad decisions,
right,
then you're going to have more companies like Fastenal sharing in the benefits. I think it would just be amazing. And because then human spirit and kindness and empathy and ingenuity just takes care of the rest. You just have to provide the playing field.
Imagine if the markets just rewarded those behaviors by default. The kind of world we'd be in, that'd be amazing.
Yeah, no.
Yeah. Well, thank you so much, Paul. This has been a longer conversation, but every moment of it was really insightful. I appreciate you putting yourself out there and helping us understand some of these things in more detail. How can listeners connect with you and get your book, Capital Offence?
Yeah, well, thank you, Daniel, for having me. It was a very good conversation. So my book is called Capital Offence, Why Some Benefit at Your Expense. And you can order online at Amazon, Barnes & Noble, Thrift Books. The odd store has it on the shelf, but not many. And there should be an Audible version available very soon. We've already submitted it, so I'm hopeful that that will be out soon. And then my website, you can access it in two ways: Paddington Capital MGMT.com or Political Economy. So my name, Paul, Economy.com. And there you can put your email in and subscribe to my free blog. It comes out usually on late in the day on Monday. And so I talk a lot about this stuff, talk about what's going on in the economy, try to keep it fun. And again, I use, no financial, like fancy words, and keep jargon and keep it simple. And so trying to democratize all of this so, people who are not in the industry can participate and have a voice.
We really appreciate that. And I'll make sure all of that's in the show notes for folks to find as well. Thanks again, Paul, for coming on Escape the Clock. Really appreciate it.
Well, thanks, Daniel. It was great.
In my conversation with Paul Musson, what jumped out to me was the fundamental distinction that he drew between money and capital. We tend to use these words interchangeably. Paul made it very clear that these things are distinct. Capital is the productive value that we create, the bikes that we build, the services we provide, while money is just the tool we use to exchange it. This distortion, though, it happens when we print more money, because without creating more capital, it creates an illusion of wealth that is actually a hidden tax on our savings. That hidden tax, that really hurts our ability to achieve the freedom that we're working so hard for. This became most painfully clear when we discussed the housing market. We've all been conditioned to celebrate when our home values skyrocket. But as Paul pointed out with his example of his own home, that it went up 4x in value without doing any improvements, just by simply living in it. But there wasn't any wealth creation. That was wealth redistribution. And we're essentially locking in gains at the expense of the next generation. We're now priced out of the life that we ourselves have enjoyed. It is a heavy realization to accept that our good investment might actually be contributing to the very inequality that we worry about. We also touched on the paradox of thrift. The system is currently designed to punish prudence. If we choose to save, the central banks are incentivized to print money to force consumption, devaluing the labor we stored away. It feels like we're running on a treadmill, where the speed keeps increasing just to stay in place. Paul mentioned his personal defense against this, what he calls his central bank lunacy hedge, allocating a percentage of his portfolio to gold, not to get rich, but to ensure against policy errors. Diversification. We talk about it a lot, but honestly, in the system we're in, you have to do it. Without protecting the wealth, there's no way that we can be sure that we'll have any peace of mind. But perhaps the most critical insight that he shared was one that we've touched on many times on the show. He shared a story about a widow, and it was a stark reminder that while we're building all of this wealth and we're trying to protect it and always worried and obsessing over the future, can't forget to live today. We have to strike a balance between preparing for the worst economic seasons and enjoying the best seasons of our lives. As always, I want to hear from you. Does the distinction between money and capital change how you view your own savings? And are you treating your home as an investment or a consumption expense? Leave your response where you listen or email me at contact@escapetheclock.com. Thanks as always for listening. Best of luck beating the system and escaping the clock. I'll catch you next week. Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.